Kia ora koutou katoa. Good morning, everyone. Thank you for joining us today, and welcome back to those of you who've joined us for the past two episodes of this webinar series. My name is Taruanesh Singh. I lead BDO's risk advisory practice based in Auckland. Together with Jarrod Kerr, I'll be one of your hosts for today. Before we tackle today's topic, I'll quickly cover off a few quick housekeeping matters. I'll remind you that all attendees are on mute for the duration of the session. If you have any questions or comments, can I encourage you to post them in the Q&A panel? We're very keen to get as much interaction as possible. You can find the panel by using the Q&A button at the bottom of your screen. The presentation should last for about half an hour. Thereafter, Jarrod and I will run through a selection of your questions and provide our thoughts. And finally, this webinar, as with others in the series, is being recorded and will be uploaded to the BDO website shortly after the session. Please feel free to share the recording with your colleagues or a wider base. This is the third episode in our Rethink webinar series. Rethink is BDO's global framework, which encourages businesses to rethink their original business models and commercial assumptions as we collectively grapple with the effects of the global pandemic. Many of you will have joined our six-part Back in Business series, which focuses very much on the here and now, essentially reacting to the crisis to secure business survival over the short term. This second series takes a longer term view and centers on how to build resilience in the prevailing business environment. Focus here is on anticipating critical changes that will impact your business and value chain. I'm sure we can all agree that the world has already changed as a result of COVID-19. Therefore, businesses need to imagine this new world as early as possible and rethink how they'll position themselves for success. The key variable underpinning all of this is uncertainty or risk. That's the focus of this third episode. Over the next 30 minutes, Jarrod and I will look to answer three key questions in this space. What do business leaders make of their risk landscape in 2020? What does New Zealand's economic slowdown look like? And where should businesses focus their risk management efforts to build resilience? To do this, I'll start by running through the headline results from our latest risk survey. I'll then ask Jarrod to give us his insights on this year's top risk before wrapping up on some key takeaways and your questions. It's important to keep in mind that this webinar isn't designed to be an exhaustive list of the steps you must take to navigate the crisis or economic fallout. Given the unique nature of each of your circumstances and businesses, that's impossible to do collectively and in just such a short space of time. What it does aim to do, though, is to provide you with some valuable sound bites to consider as you take stock of where your business is now, how it's been affected, and where you'd ultimately like to take it moving forward. Now, as I said, I'm joined today by Jarrod Kerr, Chief Economist at Kiwibank. Jarrod didn't want a fluffy introduction, so all I'll say is that he's a great presenter. His work is incredibly insightful, as always, and we're very glad that he could join us today. Nigel Burbidge, BDO's Global Head of Risk Advisory, was due to join Jarrod and I today. However, he's reluctantly had to pass on his apologies. I can assure you that his absence won't hold us back, though. Having worked directly with Nigel in the UK for many years, I know that he and I share very similar views on risk. Now, with all that scene setting out of the way, I'll turn to the survey results. The Global Risk Landscape Survey and Report is an initiative that we've run annually for the past 5 years. It essentially looks to identify the key challenges that businesses are facing globally, as well as exploring certain risk factors in greater depth. As with past years, the survey involved a canvas of 500 C-suite executives from across geographies, sectors, and business sizes to identify what they perceive to be their top risks in 2020. The results aren't surprising, but do show that concerns have changed significantly over the past few years. If we rewind to 2017, the top risks were technological changes in development, or speed therein, regulatory risk, and macroeconomic developments such as Brexit and trade tensions. This year's results are very different. When asked to identify the risks they felt their business was most unprepared for, 37% of respondents flagged an economic slowdown and slow recovery as their biggest concern. This was followed closely by computer crime, such as hacking and malicious codes, and business interruption rounded out the top three, with a little over a quarter flagging this as their top risk. Risks 1 and 3 aren't a surprise. The key question here is, what more should we expect? The effects of the past few months are still very fresh and in most cases still very real for most of us. But what's around the corner? I'll defer to the Economist's experience on that and hand over to Jarrod shortly. In terms of computer crime, this has been a key threat for the past couple of years, which is understandable given how digital and interconnected our world has become. The e-commerce trend of the past decade and the push to remote working as a result of lockdowns are just a couple of examples. The challenge in managing this risk lies in its complexity. Cybersecurity is no longer about having adequate virus protection. It's now about knowing what data we hold, where we hold it, and how it's protected. It's about truly understanding our network architecture and where our vulnerabilities are. It's about keeping our people up to date and ensuring they're constantly vigilant of threats and so much more. Cyber threats are constant, as we've well seen over the past couple of days with the NZX. If we rewind just 12 months earlier, respondents flagged damage to reputation or brand value as the top risk that their business was most unprepared for. As we continue to grapple with COVID-19 and varying alert levels, a business's reputation is more valuable than ever. It's what underpins customer loyalty and, in trying times such as these, can determine whether a business survives or fails. Over the past few months, customer loyalty has really been put to the test. With supply chains disrupted and stores closed, many of us have had to look elsewhere for products and services we rely on. It's for this reason that this year's report, which is titled the Integrity Index, goes beyond just top risks and also explores how reputational risk is perceived and managed. The results are surprising and suggest that there's more work to be done. They beg the question, have businesses become complacent? The results indicate that threats to corporate reputation are constant. 70% of respondents believe their organization had experienced an event that posed a threat to its reputation. That threat level was particularly acute among family businesses and across the manufacturing sector at 91% and 89% respectively. Charlene, can we just pop to the next slide, please? Thank you. While almost all respondents agreed that business integrity is fundamental to a brand's reputation, a staggering 87% admitted that their company may be guilty of integrity washing, whereby being perceived to have integrity or be active on the issue of integrity is more important than the steps actually being taken. This is perhaps the most surprising result in this year's survey. In fact, 1 in 2 actually agreed with the statement, so long as we're perceived to have integrity, we do not prioritize putting it into practice. While there was a lack of agreement on whether customer confidence has increased or decreased, 65% believe that their customers have the same or less confidence that their business will do what is right when compared with just 5 years ago. While it may seem obvious, this is an area that must be prioritized as we look to build more resilient businesses. Between supply chain shocks and changing consumer and consumption patterns, customer confidence and loyalty will be key to finding that competitive advantage. My sense is that this trend is driven, at least in part, by the short corporate memories. We're now 12 years on from the start of the global financial crisis and many of the corporate scandals that we saw at that point. After a renewed interest in ethical business and operating with integrity, we may now be seeing the effects of short corporate memories after another period of good returns and high profits. Jarrod, I think that's probably a good place for me to pause so that we can get your thoughts on this year's top risk, economic slowdown and slow recovery, and what further disruption that might bring with it.
Okay, thank you. And thank you for inviting me to talk today. I always enjoy these BDO discussions. They're very thorough and forward-looking, which is fantastic. And what you've gone through is no surprise to me that the economic backdrop is one of the biggest risks that companies are faced with right now, and it is a risk that we're all struggling to get our minds around. We are in probably the most uncertain time. We're in the largest economic contraction in nearly 100 years. I mean, you have to go back to the 1930s depression to find something similar in size than what we're going through right now. And the response to The threat, I think, has been huge. It's been great, but much more needs to be done. So I'll just start sharing my slides. Hopefully you can see that. And the title of my slide is exactly that. Highly uncertain times and highly uncertain measures. I mean, we don't even know how to contain the virus. We don't even know if we should contain the virus. We're not sure, how our economy is going to perform in this new world where we have COVID at our doorstep almost every day. But the one point that I'd like to make, and it's one that I think we forget every crisis, is that businesses in general are a lot more resilient and adaptable than we give them credit for, particularly the ones that sit down in periods like now and say, right, what do we need to adjust? How can we change? How can we repurpose? How can we retool to meet the new world? And I think we're seeing a lot of that now. In the Auckland lockdown that we're in today, we've seen businesses that were struggling in the last lockdown actually adapt and performing okay during this lockdown. So we will, I think, improve with every lockdown. And I think a lot of our businesses will re-gear themselves for a slightly different future. And you've all seen this bubble chart here. I like highlighting it because it gives the magnitude of the problem, the pandemic, which is making its way around the world still. 24 million people have been recorded with the cases. We all know that when you look in the middle there, Africa doesn't have many recorded, but I'm pretty sure they're not doing too many testings there. So you'd imagine that number's a very small number compared to what may actually be happening out there. But the one bubble in all of this that stands out as almost a oasis is New Zealand, our little bubble of 5 million, where we get 2 or 3 a day in a second surge. That's kind of like the holy grail for this particular pandemic. What it does mean, though, is that little team of 5 million are going to be that much more nervous in opening the border to the rest of the world. It's going to be that much harder for us to justify as a country, as a nation, opening our borders up to the risk of COVID flooding straight back in. I think there's a lot we can do on the border. I think that's where we need to focus a lot more resources, increasing the capacity to get people in here, increasing our confidence in taking people in, making sure they don't have it, and then allowing them here, because that's where we could really answer some questions pretty quickly around, letting students come in. Students would love to come in, spend 2 weeks in lockdown, start studying, and then go ahead and do 3 years study. Get a few workers down here who want to work here for the next 3 to 5 years. Again, 2 weeks in quarantine's nothing for them. Their employer would pay for that. And we could even get some more longer term tourists coming down, people who want to come down for a good 3, 6, 9 month holiday around the country, in a COVID-free country. They would easily come down here for a 2-week quarantine, and they'd obviously pay their way through there. So I think there are ways we could start to open our border up, but we're not there at the moment. We're not at that. We don't have the capacity, and we certainly don't have, I think, the confidence in ourselves to be able to do that. But I think that will change. But what this pandemic is doing globally, just to give you this backdrop, global growth was running at a decent clip of about 3.5% last year, moving into this year, and that's for the whole world. Given what we know to date, global output will fall by at least 5% this year. Now that's a massive number when you count up all the countries involved and then slash their output by 5%. That has not been seen in 100 years. And then you look beneath the surface, and the emerging countries, who are the ones that grow the fastest, are the ones that come out of this the quickest. But the advanced nations, of which we're part, take a lot longer to recover. So the blue line on here I think is important because we're kind of near that blue line. We get this big contraction which we're going through now, and it takes us, a couple of years to get back to the levels of output, the levels of income that we were making at the end of 2019. This does not go away overnight. It never did. It was never going to bounce back overnight. But unfortunately, a lot of the assumptions that economists like myself have been making around the reopening of borders, our ability to go back to something close to normal, have all been pushed out. So we originally thought that borders may reopen next year. We even thought that was pretty conservative at the time, but now it looks like the borders aren't going to open much at all for the next couple of years. So you've got to ask the question, what does that mean for a tourism operator? You could expect to try and help them and incubate them and keep them alive for 6 months, maybe a year, but 2, 3, 4 years, that's something that's just not going to happen. So I think if we are in a situation where we are not allowing international tourists back into this country for years, there are pockets of our economy that really do need to change, because you just even though they are fantastic businesses, and as soon as we open our borders, we'd have a flood of tourists jumping up and down our rivers and mountains and having fun. If that's not happening, they can't go without that revenue for a long time. So there will be some adjustments coming through, unfortunately. And what does the border closures actually mean? Well, all your short-term visitors gone. I mean, we're talking big numbers. We're talking 300,000 people all of a sudden not coming into the country. The other interesting part was the Kiwis not leaving. So over winter, the winter period we've just had has actually been stronger than normal because Kiwis haven't left. Kiwis who would rather have gone to a warmer climate over winter, stayed here, strapped on some skis, went down to Queenstown and actually did their bit to boost tourism over that period. And we actually saw on our credit card data and information that we've got that we've actually had a reasonable winter. The problem is summer. See, summer Kiwis don't normally go anywhere or not as much. And we really do rely on the foreign tourists coming into summer. So I think we're going to have a bit of a weak summer in those sorts of areas, tourism related areas. And then in terms of what it means for our general population growth, the net permanent migration, we had a surge into COVID. I've got 2 mates from school who live overseas, and as soon as the pandemic looked like it was starting to spread in February, they flew down to New Zealand, and they haven't left, and they probably won't leave for a while. And I think we've all got stories of knowing people who have rushed back to the cleanest country in the world. From here though, we need to make a guess as to how that plays out, and we think naturally with your borders closed, net permanent migration just trends down to zero until the borders open back up again, and then hopefully we get a bit of a bounce. But that there complicates a lot of things around our economic growth, our housing market, that we need to take into account. So New Zealand's recovery, if you like, will look something like this. It was going to be a V shape of sorts, a sharp V, and then a little bit of a long recovery to the 2019 levels. With another lockdown, which we're going through now, it sort of turns that V into a little bit more of a U, and just takes us that much further away from getting back to normal. Another lockdown and another lockdown and another lockdown will just continue to see these growth numbers flatten out, and that period of time that it takes to recover fully just gets extended and extended. So we all hope this is it. We come out of lockdown and we don't have another one, but I think we're all of the opinion now that we make mistakes, could easily see another lockdown in the future. How many of these things that we're going to do, how are we going to address each lockdown? And I think one thing that I'm taking some comfort from is that we seem to be getting better at it. At least this time we didn't lock down the entire country. We locked down a city. Hopefully next time we're locking down, you know, a suburb or a company or wherever the outbreak happens, and we can trace you know, the contacts very quickly and be a bit more surgical in our closing down of parts of the economy. That would be the big improvement. But for now, we're locking down large areas, and locking down Auckland, you're losing at least 500 million in revenue a week, and then you've got flow-on effects to the rest of the country as well. On top of that, Auckland is not going out and spending in the regions while in lockdown, and what that feeds through into is a substantial increase in unemployment. It's coming. It's almost inevitable. It's just a matter of how high. So you may have heard of the last Stats NZ employment report that showed unemployment rate went from 4.2 to 4. I hope you had a good laugh at it like we did. The unemployment rate is on its way up to, you know, at least 6%, I think, in the next read, and then possibly towards 9% under our forecasts. And we're not alone. Most economists and most of those in the Treasury and the RBNZ have a similar forecast trajectory. Once the wage subsidies come to an end, we'll see unemployment rates start to rise. Now that'll put pressure on a number of things. Clearly the businesses that are making those decisions are under pressure. Clearly the employees who have been made unemployment and put into a workforce which is pretty weak to start with are going to have to face some very difficult challenges trying to find another role. And this is where I think the government's policy of retraining, you know, retooling, getting people into other areas, but also stimulating other jobs while some jobs fall over, is probably the most important work that the government can be doing right now. Wage subsidies worked. Yep, wage subsidies put a band-aid on all of this, but once that comes off, we are going to see a significant spike in unemployment. And when you see a significant spike in unemployment, any economic model will tell you, well, let's run that through a banking system. What does that do? Well, if an unemployment rate goes from 4 to 9%, default rates go from a rounding error up to something more significant. And it has an impact on just about everything from consumption to asset prices like housing. And you see house prices starting to fall in this world. So again, very simple modeling, nothing too you know, scientific here. That sort of shock will cause house prices to fall. But the good news is they're not going to fall as much as we think had previously thought. What we'll see is house prices falling around 5-6%. That's a lot better than the 9-10% we had originally guesstimated a few months back based on the information we had at the time. We came out of the first lockdown. The activity we saw in the housing market was tremendous, absolutely tremendous. And we've gone into another lockdown that'll hurt a little bit, but I've got a funny feeling that we're going to come out of the Auckland lockdown going into spring and we'll see housing bouncing again. So we've revised our forecasts up. There is a good chance that we don't see much of a fall in house prices at all, but at least we've prepared ourselves for the idea that house prices can fall. So when they don't, it's obviously an upside surprise. We've prepared for it. We've battened down for it, and we'll be better off for it going into next year, particularly if we can calibrate a market that's supported enough. We know the demand's there. That's huge, and the supply will come out if they think the market's at a good state. And the thing that, you know, the banks and the central bank are doing is making sure that interest rates are so low that it's not even a consideration for buyers. And the the ability to access credit is there. And I think that's what has underpinned the housing market in recent weeks. Happy to talk about that in more detail with the Q&A. The other part here is, what is inflation doing? The central bank has a dual mandate. They're trying to maximize employment, as I just said. Unemployment's rising, underutilization, the number of people who may work a few hours but want a few more hours, that's rising. The level of employment, percentage of employment, it's all declining. The numbers we're seeing is pretty messy for now. So that part of their mandate is moving away from them. The other part of the mandate is stable prices, inflation. You want inflation running about 2%. New Zealand's inflation will run around 0 in about 6 months' time based on our forecast. So again, their other mandate has just moved away while the first mandate was running away, and you're sitting there as a central bank saying, well, I'm supposed to be focused on these two things. How am I going to get them back on target? And their only way is to cut interest rates, slash interest rates. Well, they've done that. What else can you do? Well, you can do a large-scale asset purchase. You can buy government bonds. They've bought, I think, about 30-40 billion so far. They're going to buy 100 billion in total. Problem is there's not that many government bonds out there. In the process of buying 100 billion government bonds, they're going to take 60% of the market. If you just keep going at that rate, the market would become illiquid, and the other forced holders of government bonds, like banks, fund managers, insurers, you're taking the high quality liquid assets away from us, and we need those for capital. We need those to meet future obligations in insurance companies and superannuation. So this is where the next piece of the jigsaw puzzle gets quite complicated, and that is the introduction of a negative interest rate. Negative interest rate, to me, is an ugly thing. It's something that we don't need, particularly given where we are right now. But it's something the central bank is pretty keen on delivering. So we've got a cash rate of, just 25 basis points, very, very low. They're talking about cutting that 75 basis points from plus 25 to minus 50 to see if that can really kickstart the economy and get interest rates even lower. Now, for all businesses, households, mums and dads, you will not face a negative interest rate directly. You will go to the bank and we'll still give you a 0 to slightly above 0 rate on your deposit, and we will then be offering you a very cheap mortgage rate that has a 1 in front of it rather than a 2, and that will be the extent of the move for most people. But for wholesale customers, for wholesale users of interest rates like banks, insurance companies, fund managers, we will all be delving into the deep negatives because the entire government bond curve will trade negative, which means a 5-year government bond might be yielding minus 40 basis points on it. And we as a bank would buy a 5-year government bond for $100. Here's the $100. The government gives us an IOU of $100, but only pays back 98 because of the negative interest rate. So great for the government, but it's a tax on the financial system. And that tax on the financial system has impacts on profitability and the functioning of financial assets and markets in the country. It's a risk that I don't think we need to take, given we can slam interest rates lower by simply adding a bank lending facility. And a bank lending facility would be one where they give us very cheap funding for 25 basis points plus off the current OCR, and they say, right, focus on that pool of funding. Don't go out there and fight over retail funding. and get out there and lower all mortgage and lending rates. And that would happen just about overnight. It has in Australia. Their mortgage rates are about 70, 80 basis points below ours. They got the same cash rate. The main difference there is the bank lending, and they've done it throughout the world. They're going down the path of doing bank lending and not negative interest rates. Our central bank wants to do both together, and I think it could be dangerous. But the one thing that I want your businesses to take away from today is don't worry about interest rates. I've been saying it for years. Don't worry about interest rates. They are either going nowhere or they're going down. And in this case, I think they're going down yet again, excuse me. But what that means for anyone out there who imports or exports or has any exposure to the Kiwi dollar, it's going to be an interesting year. You see, we have looked so much better than the rest of the world, and the US dollar has weakened at times, Aussie dollar's weakened at times, and at times the Kiwi dollar has really been pushed quite high. I mean, it was 8% above the Reserve Bank's forecasts going into their last meeting, and it's simply because we look better in this world than most countries for now. If we do this radical negative interest rate from the central bank, we will look a little crazy compared to the others who refuse to do negative rates. And foreign investors will look at the Kiwi dollar as being a place that's a little too risky to throw cash, to throw their capital. So what we would find in that world where we're going negative and Aussie and the US are not going negative, as they said they won't, our currency will fall quite sharply against both the Aussie and the US dollar and probably most currencies around the world. That's probably part of the genius behind what Adrian Orr and the RBNZ are thinking, try and get the currency lower to help exporters. And I think it's definitely a risk that all companies should be thinking about next year who have exposure to a Kiwi dollar. I think that if we do see negative rates, it's going to be quick and it's going to be sharp, and we will see a currency dropping into the 50s very, very quickly. So I just wanted to wrap up there, but I was going to show just a couple of cool charts that we can delve into the detail if you like in the Q&A. We've got total credit card spending across the bank, and we've just been looking at this in the last couple of days. It looks like we're seeing, similar moves than what we saw in the first lockdowns. We've seen credit card spending in Auckland. It was a little bit strong going into it in the few days going into lockdown, but then over the last week and a half, we've seen spending activity in Auckland drop away. Compare that to the rest of New Zealand, and it's only been a very small impact so far. And again, if you look at food and groceries, the food and groceries is the fun one. That's where you get the great toilet paper rush. You get people running in there, stocking up for the next 12 years. We saw a bit of that in Auckland. Not a lot this time, not as bad as last time. And we're finding a lot more click and collect and the ability to go down and sort things out with your restaurant. So activity in this level 3 is much higher than the last time we were in level 3 coming out of level 4 and down. So watch this space. We're going to flesh this out a bit more, but the data that we have seen in the last week and a half is quite encouraging. The usual patterns that you would see going into and out of a lockdown look to be in place, but the exaggerated moves of the first lockdown look to be a lot less in the second lockdown. We've kind of gotten used to it. Businesses already had plans, what to do, how to react, and just got on with it. The one thing that really has, I think, been reinforced again is the move online. That was the digitization of our economy, our banking system, everything has just been reinforced now. So the first lockdown got us used to doing a Zoom call or working on Teams. Now it's just part of our lives. We're used to it now, and online spending has seen a huge surge over this time. And as banks, we've issued more and more credit and debit cards over the last 6 months as people are using cash, less and less. So that's been an interesting move. And I think one interesting takeaway has been the businesses who are able to adapt and involve, digital, online, fast methods of payments, click and collect. These sorts of businesses have survived, whereas some of the other ones are clearly struggling. So it's all about adapting and resilience. But I think we've seen some remarkable numbers in the last 6 months. So I'll hand it back. I'm pretty keen to hear your questions actually on all of this.
Thanks, Jarrod. That's incredibly insightful, and it's a lot to take in, a lot of information there, but there's some great messages, and I can see that there's quite a lot of questions starting to pile up. So a bit of chat to come, but just before we do that, I just wanted to try and bring this all together a little bit by sharing a few headline suggestions on where best to focus as you rethink your approach to risk management and ultimately bolstering resilience. In no particular order of importance. Scenario planning, I think this is a key tool. We've seen a lot more businesses start to use this on a weekly and monthly basis over the past few months as the pandemic has hit. Quantifying the unknown to the extent possible will allow you to strengthen your defenses and plan for the worst case scenario should that eventuate. Preparation is key here, and I'm sure we've all reevaluated what's probable or even possible at least once or twice over the course of this year. Structured approach to risk. This is clearly a key one. Far too many businesses have an ad hoc or reactive approach to risk, where risks are only addressed fundamentally when they materialize. The events of this year and just how unprepared some businesses were is a testament to the need for at least some proactivity in this space. Leverage what you already do. Many businesses already do a lot in the space. Don't reinvent the wheel, but take this as an opportunity to rethink whether your approach is fit for purpose and truly adds value. Consider whether your framework is a good governance compliance exercise or whether it truly informs decision making and board and exec level. Do something. A robust risk strategy doesn't need to be complicated, time consuming or costly to implement. Simple is good as long as the responsibilities are clearly defined, mechanisms for identifying and capturing risk are established, and timely monitoring and reporting are included. Even the most simple framework will drive action. It's impossible to predict and prepare for every eventuality, nor is it a good use of anyone's time. So focus on what's most significant, your most significant uncertainties and exposures. Link efforts to your strategy. Knowing what your risks are will only really deliver a benefit if it informs decision making. Take time out to rethink what your business might need to look like in the future. Risk and strategy are two ends of the same issue, one being where you'd like to take your business, the other being what might stop you from actually getting there. Accountability. Having a plan or actions are good steps, but they hold little value if they're not communicated or actually delivered. The same holds true in relation to organizational integrity and culture. If you ask people to operate in one way, but then allow them to act in another, that becomes the accepted norm and part of the culture of your business. Your values and integrity are effectively diluted. And lastly, leadership. To add any real value, a risk framework has to have buy-in from the executive and board. Simply paying lip service will have little to no effect. And this is particularly true when it comes to integrity and trust. Leaders need to be seen walking the walk and living by organizational values. So with that, I think we should start tackling some of these questions, Jarrod. And there was a good one that I saw quite early on, which is around In terms of lockdowns, every lockdown costs the economy, closed borders cost the economy, but the risk in the forecast turnaround is having productive people retrain people and businesses that can pivot their models. So the question here is government support and bank support and institutional capital enough and deep enough to keep us going in that transitional period?
I think that's I think that is the question that is being asked, but needs to be properly answered. I think we're getting a good response from a government who had very little time and very little resources to react during the initial lockdown. And I think what they did was pretty much bang on with the resources and time they had. That's then. This is now. Now we're trying to rebuild an economy into the future, and we've been given, in my opinion, a golden opportunity to invest in areas where we failed over decades and reinvigorate, re-engineer an economy, that's a bit more future-proof than the one that came into the pandemic. We can actually make this, one of those starting points of real change, and that kind of involves what you're talking about there. You can throw a band-aid at it, which is a wage subsidy, and that certainly helped, but you are potentially just prolonging someone from losing a job and then having to go and find another one, or you may have legitimately saved, thousands of jobs. And I think it's a mixture of both. We don't know until we take the band-aid off. But where to from there? That the government is, pouring resources and money into retraining and trying to get people into different industries and different areas. But it's a difficult job because we're losing hospitality jobs, which are 60-70% female jobs, and we are stimulating construction jobs, which is the exact opposite. It's 70-80% male jobs. So yes, we can try and retrain some women to go into construction. That'll help for sure, but we also need to try and create other jobs that are better suited for the skills that have been disrupted on the other side, and that's the difficult part. So there is a lot of work going behind the scenes trying to figure out the way we can repurpose industries. We can get people into other areas, and I think that's where we'll need to be open-minded. We'll need to encourage mobility, working from home, these sorts of things, to try and slot people in across the economy, because there are parts of the economy that are running pretty much as is, like farming. That they have some issues, but geez, they're an essential service and they flew through both lockdowns. I imagine they're screaming out for workers. I know horticulture, kiwi fruit, some apples and the rest of it, they're doing exceptionally well. There's a huge surge in demand for kiwi fruit globally because of the type of fruit it is. So we're going to need someone to pick that. We're going to need people to help out in that area. But that's a very different skill set or part of the country than serving coffee in Queenstown. So it's one of those re-engineering situations that I think will take a lot of time and a lot of courage to get through. But we are coming out of this, I think, with a new workspace just about everywhere you look. The first lockdown, I think, showed us that we were on a path, a very slow path, to a more online, a more digital way of working. And then we took what may have happened over 5 years and we condensed it into 6 months. And we're now sitting here, well, we can do a lot of the stuff from home. We can do a lot of the stuff online. We can work in a more productive way. And that's kind of pulling me into this other question that I had on my mind here, which is a good one. Assume the large proportion of unemployment comes from tourism and hospitality. Are there productivity gains to be made or discovered during lockdowns that may actually cause more people being laid off? Well, in my experience and in talking to my friends at BDO and other accountants and other lawyers and other financial services, we've taken the opportunity of looking at the workforce and saying, if you can work from home 2 to 3 days a week, go for it. That means our office space, which is costing us a fortune, was this big. We could possibly make it this big and save, a good amount of money over that time. And there are a lot of companies, particularly financial service companies, that are looking at that. But nowhere in that discussion, to my understanding, was there okay, that means we can also get rid of these people. Not at all. It's just a huge productivity gain and gutting a cost, keeping the same number of people, and potentially even increasing your output, because people, I think we've proven, produce more when they're working from home.
That's a great point. One of the questions that I was actually sort of mulling over while you were stepping through your slides was around this concept that everything's pointing towards a recession, and that we've already seen the economy pull back. We know that it's not going to just bounce straight back to where it was, but more anecdotally, we're certainly seeing, you can see it in the housing market, you can see it around town, you can see it in spending patterns. People are still spending money, and it's almost as if, I think we had Sir Bill English on about a month ago in one of these sessions, and the term he used was we're bouncing or sort of springing into a recession. Do you think that people truly appreciate the impact and the effect that's coming? Or are we still a little bit kind of living in our bubble at the bottom of the world, and that things aren't that bad?
I think there's a few things going on there. There is this particular shock was so orchestrated and sudden. We woke up one day, we heard about a global pandemic, we're told we're going to go into lockdown. We knew, we can all go back to the exact day we went into lockdown. Bang, that's when we started contracting. Then we were in lockdown for a period, and then bang, we came out of it. Okay, every other recession starts off with something bad festering away, and then a lot of other elements and confidence and concerns expose this, and quite often it will involve a financial system pulling back, banks going, oh my goodness, something's wrong. The last one was a banking crisis. That took a year to figure out that it was a full-blown banking crisis. Took another year to go through the carnage of that banking crisis, which then went global. So something started in 2007, really blew up in 2008, and we weren't really recovering until 2009. We're counting this in months and in very short periods. So the impact is much larger of shutting down, 40% of your economy for 6 weeks. That's going to cause a significant contraction and recession, yes, but we've bounced back quickly on our own terms. We're the ones that say we're coming out on this date and we're going back on this date and this date, whereas other recessions are a lot more nerve-wracking, if you know what I mean, and uncertain and take longer to happen. So I think, yeah, we came out of lockdown, but we came out of lockdown with our heads held high. We did this, we smashed it. Let's go spend. There was a real let's go out into the regions and spend money in those shops that we know are losing international tourism. There was a real sort of national pride about it, and I think we sort of fought our way out. And I really think we're going to fight our way out of this one as well. But as an economist, I've got to still sit here and say, so much damage has been done. We can't escape the fact that given the change to at least 5% of our businesses is so much that we may lose them, and there will be unemployment on the back of that. We need to take it into note. We need to take that into consideration. But there is, I think, a very good chance that we wake up in November, December, housing market's roaring, as you say, spending's doing very well, and we're feeling, quite good going into next year. But overhanging us still is the fact that our borders are closed.
Yes.
So when the borders are closed, at least 5% of us are struggling. That's your tourism and your education. And I would at least like to be able to turn the tap on to the education. There's no reason why we can't bring in students here. We should be confident enough to bring students in here to quarantine for 2 weeks and then let them into the universities.
I think that's a key point, isn't it? That the speed of recovery, one of the key concerns coming out of the survey was not just the slowdown itself, but then how slow that recovery might be. I think the thing that people and businesses need to be very conscious of is that it's going to be quite different depending on what part of the economy you operate in. There are going to be areas which are completely reliant on government policy, such as tourism and when we open the borders. There's going to be others that are somewhere in the middle, like education. The tap, as you say, can be turned on perhaps earlier than others if the right controls are in place. And then there's other parts which, as you say, are seeing higher than normal sales and more business than they've ever been able to manage. So it's going to be a little bit patchy depending on what industry you're in, who you're talking to, who your supply chain or what the supply chain looks like. And that's something that we all need to be pretty mindful of. It makes for a very difficult sort of task for government to try and implement policy that's a bit uniform across the economy when you've got such disparity throughout it.
Yeah, and unfortunately, it's one of those things you learn as you go. Like we learnt from a New Zealand lockdown, and then we were given an Auckland lockdown. You think, okay, well, that just locks down Auckland, right? Well, no, Aucklanders can't leave to the regions next door, and the regions next door get Aucklanders every weekend for holiday homes. They also get trades that come out of Auckland and there to do work, and Auckland also gets trades that come from, Northland or the Waikato to come up and do work in Auckland. So all of a sudden, even though construction was running, that there were pools of workers that just couldn't get to where they needed to go. I had a road show last week that I was supposed to do in the regions. All of it had to be cancelled because I couldn't get out of Auckland. So that's you just have these things just don't happen, and you can't prepare for that. It just stops. And you either turn it into a webinar or you try and rebook it down the track.
Yeah, definitely. There's a question here that we've got, which is specifically around the survey and asks whether ability to access capital and lack of capital to invest and grow businesses, was that a perceived risk coming out of the survey? The answer to that is in parts. It was a bit mixed. It wasn't one that was uniform and had a consensus globally, which meant it bubbled to the top. There were certainly some markets where that concern was pretty key, but I think it was offset in a lot of places by cheap debt and people being able to access debt that way. But it sort of leads another question to my mind, which is, we're heading towards, we're at unprecedented low rates now for debt. And as you say, if it's heading anywhere, it's going to be down. But is the appetite to lend, business lending this is, there with the banks, or do you think it'll be there over the next 12 to 24 months?
I think the answer is simply yes. Answer is definitely yes, but it depends on the industry, the region, the type of business, and the exposure of the bank that you're dealing with. I hate to go into that sort of detail, but if you want to speak broadly speaking, the answer is yes. The appetite for lending is there, particularly for a bank that wants to grow versus maybe a bank that just wants to defend its position. There will be differences in there. Some bank, for example, may already have a lot of agriculture loans or farming type loans, may not want to expand again in there, so you might have to try and find another bank who wants to take on risk in that area. So it can get a bit specific. The main message there is don't use one bank. If one bank says no, or we can't quite help you on that, there are, you know, other banks out there. Each bank has got its own sort of niche markets, but broadly speaking, and particularly in the SME space, when you're coming up with exciting, you know, new businesses to tackle all of the problems that we're talking about right now, I think there'd be a number of banks out there that would be pretty excited to get involved, and you know, I work for one. I'm just seeing the next question there, which is, you know, are banks fit for purpose on negative rates? And if negative rates drop for a period, you know, what will that do to house prices? The negative rates question is an interesting one. Are we fit for purpose? Well, we've been told we have to be fit for purpose by November this year. So there's no excuse. My understanding is there's a few technical issues around contracts. So a contract that you might have with a wholesale client that says an interest rate can't go negative, you may have to re-sign that contract. The only people that seem to survive in any situation seems to be lawyers, but anyway, they'll be loving this. In terms of when that's implemented and what will that do to house prices and the likes, well, you are adding more gasoline to the fire. So as we came out of lockdown level 3, there was a bunch of transactions that couldn't have taken place over level 4. They all got cleared, and then there was also a bunch of people who were in lockdown, looked around and went, geez, it really is time to get our own place or get out of this place. And bang, we saw a huge spike in inquiry, and banks being banks just decided there is a huge surge in demand for loans. Let's fight for them. So we fought for them by cutting interest rates, and you saw that even fueled more demand. And you know, you've read the press releases from the REINZ and Barfoot and Thompson and you know, the core logic data. It's all, you know, off the charts. You know, they've got record months for winter. Part of that is just a, you know, pent up demand. Things that weren't being able to be done in March, April, May were just banged into sort of June, July. That's fine. But the price and the strength beneath that move really has persisted. Our New Zealand's housing market is growing at 9% over the last year. 9%. Here we are forecasting a decline of, you know, -6%, which means that we need the unemployment rate to pick up, and then things come off a little bit in the first half of next year. If we're right. If we're wrong, we could just continue to see house prices running through into next year.
Fantastic. Well, thank you for that. Look, I'm very conscious that we're just about out of time, so I think we'll have to wrap it up there. But thank you for all of the questions. For those of you who put your name into the questions there, we'll certainly look to tie that back to the registration list and send you a response. But look, Jarrod, all I wanted to sort of wrap up is by saying thank you. Really appreciate your insights and your input onto the session today. You know, this particular risk, what's going to happen, what's the economy going to look like over the next 12, 18, 24 months is by far the biggest issue on everyone's mind, whether in business or even on a personal front. So I really appreciate the information and detail that you've been able to add. I'd just also like to just remind everyone about the recording, which will be on our website within the next day. And just to flag that episode 4 of this series is coming up in a fortnight's time. It's building a more resilient business, and it's going to be particularly interesting because our David O'Connor will be talking to Adrian Littlewood, Chief Exec of Auckland Airport, about how Adrian's looking to rethink the future of that particular business. And given the challenges that they're facing, I'm absolutely certain it'll be an interesting conversation. That's on Thursday, the 10th of September, same time at 9 a.m. and you can register on the website for that. So thank you very much, and from everyone at BDO, I appreciate the attendance. Thanks everyone. Good morning.